Welcome to our Mortgage Acceleration program. It may cost more than renting, but the benefits of home ownership cannot be denied. We've all heard it before, buying a home is part of the Canadian dream. And while it is initially more expensive to own a home than rent, there are multiple benefits of buying a home that you just can't get from renting long term. So let's take a look at 4 benefits of home ownership that can help you create a secure financial future and build wealth over time. First, buying a home is a good investment. Rental costs are creeping up, and while home prices are also increasing, when you stay in long enough, the value of your property will traditionally go up as well. And when you're ready to move, you are likely to get a substantial return on your investment. Because interest rates are currently low, now is a good time to consider taking the plunge if you're not already a homeowner. Secondly, owning a home can stabilize your budget. When you're a renter, there are many things out of your control. Landlords can and often do raise rents. In most cases, you can't guarantee your rent will remain stable for a long period of time. Owning a home, however, means you know the mortgage payments, usually on a fixed rate and a fixed term of up to 30 years, and therefore you can plan accordingly. And the longer you make your mortgage payments, the more equity you build. Third, credit credentials. The longer you demonstrate a track record of making your mortgage payments on time, the more your credit rating increases. And this is important as it demonstrates to future lenders your reliability concerning how well you handle debt. Fourth, your nest egg continues to grow. Every time you make a mortgage payment, you're one step closer to paying off your loan while building equity at the same time. What's more, as your home increases in its value, so does the amount of equity that you have at your disposal. When necessary, you may be able to borrow against that value to make home improvements or for unexpected medical or educational expenses. This type of home equity line generally offers lower interest rates than credit cards and can be used to pay off high-interest credit card debts. So those are just a few advantages of owning a home. But today we want to discuss something else. What about the trapped equity that is inside your home the longer you have your mortgage? There is, in fact, a tipping point when it no longer makes sense to leave that equity sit idle. Consider this. It takes a typical Canadian couple 25 years to pay off their mortgage. At 40 hours a week, 50 weeks a year, for 25 years, the average homeowner will work 50,000 hours in effort to pay off their mortgage, but end up cash poor because it took them so long. That's a lot of sweat equity. This means that on a $400,000 mortgage, they will end up paying over $508,000. What this really means is that they paid the bank $108,720 over the cost of the house. This is the invisible interest payments that they'll be making over the 25-year period. But there is a dirty little secret the bank doesn't want you to know, and it's costing you a fortune. As you know, home equity is the trapped value of a homeowner's interest in their home. Utilizing the trapped equity within the home, an owner can leverage that asset to catapult a significant wealth accumulation account. Let's look at a real-life situation. We are presently in a hot seller's market, and Eric's current market value is $650,000 for his home. His present outstanding mortgage is $250,000. Eric's monthly payments are $1,740.80. The trapped equity in his house is $400,000. Eric has been taught That's a good thing. But who taught him? The bank. But in reality, this means that Eric has a $400,000 asset earning 0%. Absolutely nothing, year after year. He would never do this with a GIC or any RRSP. But he has never stopped to consider his biggest asset of all, his trapped equity. In reality, we had our lender extend Eric up to 80% of his current market value, which would have been $520,000. So we secured Eric a new conventional mortgage of just $480,000. To keep the payments low, we spread it out over a 30-year amortization and locked in a 5-year term. Eric's new payments were $278 weekly. Moving to weekly payments from monthly ones will save Eric a few years of payments. Eric's new payments were very manageable. So after paying off the old mortgage, Eric winds up with $230,000 in liquid equity. He used $30,000 to pay off all his credit card debt and his student loan. This freed up over $448 of positive cash flow for Eric every month. The remaining $200,000 was then deposited into a non-registered creditor-protected account. This account featured a 100% deposit guarantee. This is where it gets interesting. You see, one of our strategic lenders then advanced Eric a matching amount in the form of a non-registered, interest-only line of credit. This matching amount was deposited into a second creditor-protected account. This means that Eric now has $400,000 to work with. The money was invested into a portfolio with a historical rate of return of 10% or better. Please note that past performances is not an indication of future performance, and rates of return are not guaranteed and will therefore fluctuate. The plan is to allow Eric to have that cash in the account compound annually for 10 years. Since the interest-only payments are tax deductible, approximately $60,000 may be declared over the next 10 years. So 10 years from now, averaging 10% a year, the total amount within the creditor-protected accounts would be approximately $1 million. At this point, the estimated mortgage remaining has been reduced to just $350,000. Eric may choose to cash out and pay off the mortgage. He'll be mortgage-free in 10 years, not the 25-year program he's on presently. This would leave Eric just under $750,000 sitting in a cash account, continuing to compound. Or 10 years from now, Eric just might decide not to pay his mortgage off and continue to compound the $1 million account. At an annual earned interest rate of 10% or better, Eric could certainly afford to continue to make his mortgage payments, earning over $100,000 in interest every year. You see, this is what the bank doesn't want you to know, and it's what you don't know that's costing you a fortune. So what should you do next? It's very simple. Complete our free mortgage qualifier. You're under no obligation, but if you do so, we'll be able to determine very quickly what your numbers look like.